I've been in the markets for over 7 decades now. And if there's one thing I've learned, it's that volatility is just part of the package. It's like getting rained on once in a while when you go outside. You don't curse the sky every time it happens. You just carry an umbrella and move on. People get excited when the market goes up, and they get scared when it goes down. But let me tell you something very simple. Markets going up and down, that's not chaos. That's just investing. You don't need to be a genius to understand that markets move. They always have, and they always will. Prices go up, prices go down. That's the nature of the game. If you find yourself surprised by that, then maybe you're looking at investing through the wrong lens. Because, quite frankly, volatility isn't something unusual. It's not an anomaly. It's built into the very structure of how markets operate. Now, I've seen just about every kind of market you can imagine. Booming bull markets where everything feels invincible, and gut-wrenching declines where even the best businesses see their stock prices cut in half. And through it all, the one thing that's remained consistent is this. Volatility shows up, but it doesn't stay. It comes and goes just like the seasons. You don't plant crops expecting perfect weather every day. You prepare for storms and you keep planting anyway. The mistake people often make is thinking that volatility equals risk. That's not true. Real risk is not knowing what you're doing. If you buy into a business you don't understand and the stock drops, you're going to panic. But if you own a business you believe in, a business with solid fundamentals, good leadership, and a clear future, then the price going down shouldn't bother you. In fact, you might want to buy more. Think of it this way. If you're shopping for hamburgers and the price drops, you don't get angry, you smile, you say, I'll take more. But for some reason, when stocks drop, people react the opposite way. They get fearful. They sell. They run for the exits. That's emotion getting in the way of logic. That's fear overpowering reason. There's an old saying that the market is driven by 2 emotions, fear and greed. I'd add a third one, impatience. Everyone wants to be rich tomorrow. But the truth is, wealth in the stock market doesn't come from reacting to every swing. It comes from holding quality assets over time, letting the businesses do the hard work while you remain steady. If you think about the greatest companies of our time, they didn't become great overnight. They went through challenges, competition, setbacks, and yes, volatility. But their true value came from their ability to adapt, grow, and deliver value to customers and shareholders. If you stayed with them during the rough patches, you were rewarded in the long run. So when markets wobble, and they will, you need to ask yourself, has the business changed or has just the price changed? More often than not, it's just the price. And that price is being set by a bunch of people who are trying to outguess each other minute by minute. That's not how you build wealth. That's how you chase your tail. Patience is key, and understanding what you own is essential. If you're relying on the stock ticker to tell you how your investments are doing, you're already on shaky ground. You should be relying on the performance of the actual business behind the stock. That's what matters. I've always said that the stock market is there to serve you, not instruct you. It offers you prices every day, but it doesn't demand that you act. In fact, the best investors often do nothing when others are panicking. They wait, they watch, and they only move when the opportunity is right, not because the market got jittery. In the end, volatility is not your enemy. It's a test. It asks, do you know what you own? Do you believe in it? Can you stay calm while others lose their heads? If you answer yes, then you've already separated yourself from the crowd. You don't have to predict the next downturn, and you certainly don't have to react to every little dip. What you do need is a clear mind, a long-term view, and the discipline to stay the course. That's how real wealth is built. Quietly, patiently, through all the ups and downs. When you buy a business, you're not buying a lottery ticket. You're buying a piece of something real, an enterprise with products, employees, customers, and hopefully a future that looks better than its past. And if that's true, then it makes no sense to obsess over what the price does tomorrow or even next month. What matters is what the business does over the next 5, 10, or 20 years. The market on any given day is a voting machine. People react to news, to rumors, to headlines, to fear, to greed. But in the long run, it's a weighing machine. The true value of a business gets reflected eventually, not instantly. And the people who do best are the ones who don't get distracted by all the daily noise. They keep their eyes on the long road, and they understand that real progress takes time. You see, most people aren't wired to think long term. They want results now. They check stock prices every hour. They watch financial news like it's a sporting event, and they confuse motion with progress. But investing isn't supposed to be exciting. It's supposed to be logical, boring even. You identify great businesses, you buy them at a sensible price, and you let time work its magic. If you find a business that you believe will be more valuable in the future than it is today, and it has a durable advantage, then the smartest thing you can do is hold it. Let it compound. Let the earnings reinvest. Let the brand grow stronger. Let the management do what they're good at. Over time, you'll likely do very well. Not because you're smarter than everyone else, but because you were willing to wait while others chased shortcuts. The stock market will tempt you. It will throw 1,000 distractions your way. It will make you question your patience, your process, your convictions. But just remember, every time you switch from one idea to another, every time you sell too early or chase something shiny, you interrupt the compounding process. And compounding is one of the most powerful forces in all of finance. But it only works if you let it. You don't need 100 investments. You don't need to swing at every pitch. In fact, some of the best returns I've ever seen have come from just a handful of decisions made over a lifetime. One good idea held long enough can outperform a dozen trades done in a frenzy. That's the beauty of focusing on the long term. It puts time on your side. Now, that doesn't mean you ignore reality. Businesses can change. Fundamentals can erode. If something is no longer what you thought it was, then yes, it makes sense to reassess. But you don't need to reevaluate a business every time the stock price moves. Price and value are two very different things, and they don't always move in sync. The great advantage you have as an individual investor is that you don't have to do something just because others are. You don't have to match the benchmarks. You don't have to explain yourself to a committee every quarter. You can be still while others are frantic. And that quiet confidence, that ability to think independently and act patiently is a real edge. Every time the market dips, people panic. But if you're thinking long term, you see it differently. You see opportunity. You see the chance to buy more of a business you already like, but now at a better price. That shift in perspective from reacting to planning, from short-term fear to long-term vision, is what separates investors from speculators. The best businesses in the world don't grow in straight lines. They face challenges, they make mistakes, but over time, if they continue to deliver value, they become worth more. And that's what you're betting on, not perfection, but progress. If you want to do well over a lifetime, think in decades, not days. Tune out the noise, stay with your convictions, and above all, trust in the process of time. Because in the end, time rewards discipline, not drama. In investing, your biggest enemy isn't the market. It's not inflation. It's not interest rates. It's not even bad luck. Your biggest enemy is often looking right back at you in the mirror. Emotions, fear, greed, impatience can turn even the smartest investor into their own worst nightmare. And the trouble is, most people don't even realize when it's happening. Fear, greed, impatience can turn even the smartest investor into their own worst nightmare. And the trouble is, most people don't even realize when it's happening. You could have the best information, the clearest data, and the soundest strategy, but if you let emotion take the wheel, reason goes out the window. It happens all the time. The market drops a few hundred points, and suddenly people forget what they own. They forget why they bought it. They sell not because the business changed, but because the price did. That's not investing, that's reacting. When people are fearful, they sell at the bottom. When they're greedy, they buy at the top. It's a cycle that's played out over and over for generations. But the real damage doesn't come from the market's movement. It comes from the decisions people make in response to those movements. Markets recover, emotions don't always do the same. If you let emotions dictate your investing behavior, you'll always be chasing something, chasing safety, chasing returns, chasing trends. But investing isn't about chasing. It's about staying still when it's hardest to do so. It's about making rational decisions when everyone else is losing their head. That's when opportunity is born, not when things feel good, but when they don't. There's a reason why discipline outperforms brilliance in the long run. Most people know what they should do, buy good businesses and hold them, but they don't always do it because it's hard to sit still when the headlines are screaming and the red numbers are flashing. It takes mental toughness to say nothing's changed and stay the course. Now, that doesn't mean you ignore reality. If something fundamental has changed about a business, it makes sense to reevaluate. But if all that's changed is the stock price and your only reason for selling is that other people are selling, then you're not investing. You're following the crowd. And the crowd, more often than not, gets it wrong. There's an old quote, "Be fearful when others are greedy and greedy when others are fearful." That's not just a clever phrase. It's a way of thinking. It's about separating emotion from decision. It's about doing what makes sense, not what feels good. Because what feels good in the short term often turns out badly in the long term. Fear and greed come in disguise. Sometimes they look like caution or opportunity, but you have to know yourself. You have to ask, am I making this decision because it's logical or because I'm afraid of missing out? Am I selling because the business no longer makes sense or because I can't handle the short-term pain? Those are the hard questions, and most people don't ask them until it's too late. Patience, discipline, and rationality. They're not exciting words, but they build wealth. Emotional decisions might feel right in the moment, but they often come at a high cost. The market doesn't reward excitement. It rewards consistency. Think about the great businesses of the world. They didn't get built overnight. They faced challenges, recessions, bad press, but the people who held on, who ignored the noise, who stayed calm, those are the ones who came out ahead. Not because they timed the market perfectly, but because they didn't let emotion drive the car off the road. The truth is, there's always going to be something to worry about. The news will never run out of reasons to be nervous. That's part of life. But if you own a great business and it's doing what it's supposed to do, serving customers, generating profits, growing, then the smartest thing you can do is hold it. Let time do the heavy lifting. In the end, the investors who win aren't the ones who never feel fear or greed. They're the ones who don't act on it. They think clearly. They stay grounded. They understand that emotion is part of being human, but not part of making good decisions. And that little bit of self-control, it makes all the difference. Most people think volatility is something to be afraid of. They see the market drop and they immediately assume something is wrong. But the truth is, volatility is just part of the deal. It's built into the fabric of investing. You're not going to get the rewards without occasionally feeling a little uncomfortable. That's how the system works. But here's the thing. Volatility if you understand it, is not your enemy. It's actually one of your greatest allies. Because in those moments when everyone else is scared, when prices are falling and headlines are filled with panic, that's when opportunity knocks. And it doesn't knock politely. It kicks the door in. The best opportunities don't show up when everything is calm and perfect. They show up in chaos. When the market is dropping, good businesses often get thrown out with the bad. Prices fall across the board, not because the fundamentals have changed, but because people get emotional. They sell first and think later. That's when you can step in. Think of it like going to a department store during a clearance sale. If you walk in and see that all the clothes are marked down 30% or 40%, do you panic? You walk out and say, something must be wrong with this place. Of course not. You get excited. You start looking for the best deals. It should be the same with stock, but most people react the opposite way. When prices are high, they feel great. When prices drop, they get scared. That kind of thinking will get you into trouble. You have to train yourself to think in reverse. You want to get interested when others lose interest. You want to be a buyer when others are selling. That's how you make money, not by following the crowd, but by stepping away from it. Now, this doesn't mean you buy just anything when it's cheap. Cheap isn't the same as valuable. You still have to do your homework. You have to understand the business, believe in its future, and have confidence in its management. But when those things are in place and the price falls simply because the overall market is nervous, that's your moment. These kinds of opportunities don't come around every day, but when they do, you have to be ready. You have to have the mindset and the courage to act, because what looks like risk to most people often looks like value to those who are prepared, and preparation is everything. You don't start looking for umbrellas when it starts raining. You buy them ahead of time. It's not about predicting when the market will dip. That's impossible. It's about knowing what to do when it does. Volatility gives you a chance to buy pieces of great businesses at prices that wouldn't exist under normal conditions. It's about getting into the room. It's about set up a situation. It's like buying dollar bills for 70 cents. If you're confident it's still a dollar, you should be excited. In my experience, the market will always overreact, both to the upside and the downside. When things are good, people assume they'll always be good. When things are bad, they assume they'll never get better. Neither one is true. Reality is usually somewhere in the middle. If you can stay calm while others swing between euphoria and despair, you're going to do just fine. Opportunity isn't always comfortable. In fact, it rarely is. It shows up wearing the disguise of uncertainty and fear. But if you know what you're looking for and you've done your homework, those moments become your edge. You're not trying to outguess the market. You're just waiting for the right pitch and then swinging hard when it comes. The ability to act during volatility is what separates investors from speculators. Speculators get shaken out. Investors stay focused. They know that the underlying business is what matters, not the ticker tape. The price may move all over the place in the short term, but if the business keeps growing, the value will catch up. Volatility will always be part of investing. You can't avoid it, but you can learn to use it. You can learn to stay rational when others aren't. And when you do that, you put yourself in a position not just to survive the storm, but to come out stronger on the other side. That's how wealth is built, not by avoiding volatility, but by understanding it, embracing it, and letting it work in your favor. When you buy a stock, you're not buying a piece of paper. You're buying a piece of a business. That simple idea is where most people go wrong. They treat stocks like poker chips, something to trade back and forth in the hope that someone else will pay more for it later. But that's not investing. That's speculation. And speculation might give you a thrill, but it won't build wealth over time. Investing means thinking like an owner. It means looking at a business and asking, would I want to own the whole thing if I could? You should be just as interested in how the company earns money, how it grows, and how well it's managed as you would be if you were buying a gas station down the street. Because in a real sense, when you buy that stock, you are becoming a part owner. Speculators don't think that way. They don't care what the business does or how it performs. They only care about the stock price. They want to know if it's going to go up tomorrow, next week, or next quarter. That kind of short-term thinking leads to bad decisions. It's like trying to drive across the country by only looking at the 10 feet of road in front of you. You're going to end up in the ditch. If you think like an owner, everything changes. You stop worrying about day-to-day fluctuations. You stop checking the stock price every few hours. Instead, you start thinking long-term. You ask yourself, is this a business I'd feel good about owning for the next 10 or 20 years? Because if it's not, you probably shouldn't own even a single share. Ownership brings responsibility to. It means you should understand the business, really understand it. How does it make money? What are its competitive advantages? Who's running it? And are they doing a good job? If you wouldn't buy the whole company without knowing those things, you shouldn't buy part of it either. The stock market makes it easy to forget this. The stock market makes it easy to forget this. As you constant quotes and instant liquidity, you can buy and sell with a click of a button. That kind of access encourages behavior that has nothing to do with ownership. But if you had bought a local business outright, you wouldn't be checking its price every minute. You'd be focused on how well it was doing, not what someone else thought it was worth today. A good business doesn't stop being a good business just because its stock price falls. The market can be emotional, it overreacts. But if the fundamentals are solid and the company continues to grow and create value, then the price will eventually reflect that. In the meantime, those who understand what they own can sleep well at night. Speculators chase price action. Investors look for value, and value comes from what the business produces, not from what someone else is willing to pay for the stock. If a company is earning more year after year, reinvesting wisely and maintaining its competitive edge, that's what creates wealth over time. It doesn't matter how fancy your trading strategy is or how often you check charts and indicators. If you're not thinking like a business owner, you're not investing. You're just gambling with a suit on. There's nothing wrong with wanting to make money in the market, but there's a right way to do it. And the right way starts with understanding what you're buying, why you're buying it, and how long you're willing to hold it. The best results usually come from finding a great business and simply getting out of the way while it grows. Some of the greatest investments come from sitting still. Just think of it. If you owned a fantastic company run by talented people selling great products, would you sell it every time the market got nervous? Of course not. You'd want to keep it. You'd want to own more of it if the price fell. The market gives you the chance to buy into amazing businesses without having to own the whole thing. That's a gift if you treat it with the respect it deserves. So don't get caught up in the noise. Don't try to predict the next move. Just find businesses you'd be proud to own and own them. In the end, wealth doesn't come from flipping stock. It comes from owning strong businesses, staying patient, and letting time and compounding do the hard work. That's not speculation. That's investing. So when the market trembles a bit, don't get shaken. Stay calm. Stick with great businesses. Tune out the noise. Volatility doesn't destroy wealth. Panic does. And remember, the stock market is a device for transferring money from the impatient to the patient. I suggest you choose patience.